Hi everyone, welcome to Edupedia World. I am C. Radhika Singhal. In the last lecture, we were discussing regarding theories of capital structure. Today we are going to continue with Modigliani and Miller approach, the third theory. Before that, let's have a recap of the first two theories which we discussed in the last session, that is net income approach and not operating income approach. In net income approach, the main proposition was as the company increases its debt and equity mix, it is more beneficial for the company because ultimately the cost of capital or the overall cost of capital of the company reduces. This is because all these theories are on a basic assumption that the cost of debt is less than cost of equity. So when company introduces more of debt, since its weight increases, the overall cost of the capital reduces. So more the debt and leverage, or you can say more debt equity mix for the company, the more it is beneficial for the company. As per net operating income approach, all the capital structures are optimal. This is because if the company increases the debt portion in the company or debt mix in the company, the expectation of the equity shareholder simultaneously rise. This is because of the financial risk which arise due to increase in debt. Due to increase in debt, there is a corresponding increase in KE, that is expectation of equity shareholder. And because of this, there is no effect on the overall cost of capital. Since there is no change, all the capital structures are optimal. So as per net operating income approach, on the value of the firm, there is no effect of the debt and equity mix. Approach is also you can say a different variant of net operating income approach, because as per also, his theory says that the value of the firm is not affected because of its debt and equity mix. It solely depends upon its future earnings, that the value of a firm depends upon its EBIT. To explain this, has its own assumptions. It's the same which we started in our cost of capital, that there is a perfect capital market structure. So by means of capital market structure, perfect capital market structure, there is no taxation, there is no transaction cost, there is no flotation cost, and the investors are rational. So they can decide that which investment is more beneficial for the company. And he demonstrates or he explains his theory with the help of an arbitrage proof, which explains that why the value of a firm is independent of its debt and equity mix. Under his assumptions, if debt financing result in a higher value for a firm than equity financing, then investors who owed shares in a leveraged firm will sell off their holdings and invest in the unleveraged firm along with the debt portion, whatever risk is there. So you can say that a personal leverage or a personal debt is a perfect substitute for the corporate one. So whatever earnings that they get by selling off their share in a leveraged firm, plus the debt that they take from the market at a rate which is same as the corporate debt, the ultimate earnings will be more. So because of these transactions, or you can say because of the simultaneous selling of shares in the leverage firm, the buying of the share from I can say often in an unleveraged firm through selling of shares in a leveraged firm will ultimately reach to a point where the values of the two firms would be identical. So as per hypothesis, a firm's stock price is not related to its mix of debt and equity financing. Let's understand operations with the help of an example. There are two companies, Company X and Company Y. Company X is a leveraged one and Company Y is an unleveraged one. says that if the value of a leveraged firm is more than the value of an unleveraged firm, the investors of a leveraged firm will sell off their shareholdings to buy the shares in an unleveraged firm. So let's take that there is an investor A who has 10% of investment in Company X. Company X has 90,000 equity share. That means the investor has 9,000 equity share. So there are 9,000 equity share in company X which is held by the company. The investor will sell off these shareholdings at the current prevailing market price of the share. It is given that the prevailing market price of the share is 1.20 per share. So by selling off these 9,000 share, what is the amount which is receivable? Investor A will receive 10,800 on his shareholdings. Company X has 6% debentures of 60,000 each. And your personal leverage is, as you can say, is a substitute of your corporate leverage. So for 90,000 share, the company has 60,000 debt. So for 9,000 share, how much shares will company hold? 6,000 debentures. So for those 6,000 debentures, investor A could take debt from the market. So when he borrows 6,000 rupees again, now the investor is holding 16,800 rupees. This is the amount which is available for investment by the investor. Now investor A will invest this amount, that is 16,800, in buying the shares for company Y, which is an unleveraged company. Company Y market price is rupee 1. So investor A can bought 16,800 shares in company Y, right? After a year, how much dividend the investor will receive from company Y? Company Y has a total income of 18,000 divided by 1,50,000 multiplied by the holding 16,800, right? This is his share over the total earnings, which is 2,116. Less he has also taken a debt also, 6% debt of 6,000 rupees, which is 360. So the net income that the company has earned by investing in company Y is rupees 1,656. If he has not sold off his investment and has invested in company X only, that is his opportunity cost by selling off his shares from company X, the dividend that he'll receive from company X will be 1,440, because 18,000 is the earning, 3,600 will be the interest to be paid. So for his 9,000 shares, he will receive a dividend if he has invested in company X will be 1,440. So you can say without investing any additional amount, there is a gain of 216 rupees, and this is the arbitrage gain. So if the investor resort to such a change, the market value of the equity of firm X tends to decline because he is selling off his share from that firm, from unleveraged firm, and the market value of unleveraged firm will rise. So at a point that there is a saturation, you can say there is a point will come when the value of both the firm will be equal. That's why the debt equity mix do not affect the value of the firm. has restated the net operating income approach through three propositions. Let's discuss one by one. As per proposition 1, the value of a firm is independent of its debt and equity fix and is solely dependent upon its future earnings. So you can say that the weighted average cost of capital is independent of its capital structure, and in order to compute the value of a firm, it can be computed by capitalizing the earnings of the firm by its average cost of capital. That means value of a firm could be computed or is equal to EBIT upon cost of capital. Now, since the debt equity mix does not affect the value of the firm, the cost of capital of a leveraged firm must be equal to the cost of capital of an unleveraged firm. The cost of capital is not affected by its capital structure. So, value of a firm is EBIT upon KO. So, for a leveraged firm, is it EBIT upon KOL? And if I have to compute the value of a firm, of an unleveraged firm, it will be EBIT upon KOU. So, U is unleveraged. L is leveraged. But since KOL is equals to KOU, that is cost of capital of a leveraged one is equals to the cost of capital of an unleveraged firm, the value of a leveraged firm is equals to the value of an unleveraged one. So weighted average cost of capital of any firm, regardless of its debt amount, is equal to the cost of equity of an unlevered firm. And to compute the value of a firm can be computed by capitalizers is earning with the average cost of capital. As per Proposition 2. So Proposition 2 relates to the return on equity in companies where the capital structure includes some debt. This is on an approach that the expectation of equity shareholder rises with increase in the leverage. So there is a linear relationship between the cost of equity and the leverage. If the company increases its leverage, or it can say debt and equity ratio, the expectation of shareholder of a leverage firm also increases. So the expectation or KEL, so L here is leverage, and when I say KEU, it means unleveraged. So the expectation of a leverage firm is at a premium because there is some debt portion in it, so that to offset that financial risk is at a premium as in comparison to the expectation of a shareholder in an unleveraged firm. says that expectation of equity shareholder of a leveraged firm is equals to expectation of equity shareholder in an unleveraged firm plus what is the premium portion, that is in proportion to the debt equity mix. So it will be KEU minus KD, which is your cost of debt, in the ratio of your debt equity mix. And to compute the value of a firm, it can be computed by capitalizing its net operating profit after tax. This is because your debt or interest is a tax saving expense with the overall capitalization rate. So value of a firm is equal to EBIT net of tax divided by cost of capital. So value of a leveraged firm is more because debt always saves tax. So if I have to compute a value of a firm, it can be computed by adding value of an unleveraged firm plus debt into tax rate. Let's do one example to explain or to understand this concept better. Companies U and L are identical in every respect, except that the former does not use debt in its capital. U is an unleveraged one and the L is a leveraged firm. Okay, while the latter employs rupees 6 lakh of 15% debt. So assume that all the assumptions are met. The corporate tax rate is 50%. The EBIT is 2 lakh rupees. The equity capitalization of an unlevered firm is 20%. So you can know that if an equity capitalization of an unlevered firm is 20%, the KE of an levered firm will always be more than 20%. What will be the value of the firms U and L? Also compute weighted average cost of capital of both the firms. So for company U, if I have to compute the value of the firm, value of firm is EBIT net of tax divided by the cost of capital. For an unleveraged firm, its cost of capital is equal to the equity capitalization rate because there is no debt. So KO is equal to KE. In the given situation, the cost of capital of an unlevered firm is 20%. So the cost of capital of that company or KO is also 20%. EBIT is given 2 lakh rupees. So value of a firm is equal to 2 lakh into net of tax divided by 20%. That is 5 lakh rupees. Now we have to compute the value of a levered firm. Value of a levered firm is more than value of unlevered firm because there is some debt portion in it. Value of an unlevered firm is equal to value of unlevered firm, which is 5 lakh plus debt into tax rate, being debt as a tax saving expense. So 5 lakh plus how much is the debt portion? 6 lakh multiplied by 50%. This gives you 8 lakh rupees. So value of levered firm is 8 lakh. Now if I have to compute the cost of, or you can say expectation of equity shareholder in this levered firm, value of a firm is equals to EBIT upon KO. So in order to compute KO, it is EBIT upon value of firm, simple mathematical. So value of levered firm is equal to 2 lakh into 1 minus 0.05 net of tax divided by the value of levered firm. So this will give you the expectation, or you can say KO of levered firm, which is 12.50%. And now proposition 3. Proposition 3 provides a rule from optimal investment policy by the firm. It defines the cutoff rate. It says that whatever investment that the company is making, that should be at least over and above the cutoff rate. And what is the cutoff rate? This is the overall capitalization rate of the company. So whatever investment that the company is doing, that should be at least earning or giving a return equal to the KO. In simpler terms, these three propositions has the following effects. Proposition 1. The total market value of a company is independent of the level of debt in its capital structure. Proposition 2. As leverage, or you can say use of debt increases, the equity cost of capital to a levered company will also rise in order to offset the advantage accruing from the lower cost of debt. So KO will be constant at every level. And proposition 3, which relates to the cutoff rate, which is equal to the overall capitalization rate of the company. So all the new investments which are done, that is, should equal at least earn a minimum required rate of return equal to the KO. Now there is one more theory which is called as pecking order theory. Pecking order theory argues against a target debt equity ratio. As per this theory, the company will always first utilize the internal generated funds and then they will raise any additional debt and fund. This is because there is no cost of raising internal generated funds, because there is only an implicit cost. However, there is no explicit cost for generating any funds. So if the company wants to rise, or if the company wants to expand, it will first utilize its internal generated funds, that is its retained earnings, and then they will go for any debt or equity, or you can say external source of funds. So pecking order theory rests on the following assumptions: that there is a sticky dividend policy, there is a preference always for the internal funds, and there is an aversion to issue equity shares. Using debt equity, or there is a target debt equity ratio, does not have importance, but the explanation, or you can say the proposition behind pecking order theory, is the issue cost, which is nil almost in the internally generated funds. That's all for today. Thank you so much.